Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, we have Randy Frederick. He's a Vice President of Trading and Derivatives over at Schwab Center for Financial Research. And we're going to take a look at indications from the options market as well as the major indexes. Randy, it's great to have you back with us.
My pleasure,
in
Jill.
New York. Great to see you as always. Before we get into the options and indexes, let's get your technical insight because it has been quite a couple of weeks for equity trading.
Yeah, it really has. If you look at the S&P 500, which is what I focus on mostly because it's the best broad gauge of the market, there's not a whole lot of technical support on the S&P until we get down to the 200-day moving average, which is about 30 to 40 points below where we're at right now. In this type of volatility, we could hit that in another day or so. And then below that, it takes us all the way down to the correction level of minus 10%. So there's not a lot supporting the market at this point.
Well, retail investors are increasingly turning to index options to help hedge their portfolios and perhaps make speculative bets. We see a lot of open interest in the Nasdaq 100, for example, as those stocks tend to lead the market, whether it's up or down. Are you seeing the same thing as well at Schwab?
Yeah, you don't see a lot of retail interest in index options. You do when they're involved, when they have accounts that are managed by financial advisors of some sort, because the financial advisors understand that index options have the benefit of a more favorable tax structure. There's usually a 60% of the gains are taxed at long-term capital gains and 40% at short-term, no matter how long you hold them. A lot of people don't realize that. So a good example would be, trading SPX as opposed to SPY. SPY is what retail investors tend to do on their own, but their advisors will also tell them, hey, look, if you do an SPX, then you can get a little bit more favorable tax structure. The other thing that I think is a big benefit about index options is that they settle in cash. So again, the NDX or something like that versus, say, trading the QQQ, which is what retail investors have a tendency to gravitate towards those things that settle in an underlying instrument, whether it's a stock or an ETF.
All right, now the PutCall ratio, that's an indicator that you look at to judge sentiment in the market.
Yeah, so there are a lot of put-call ratios, and I look at all of them, and I cover these in my report that I put out every Friday. I've been publishing it on Schwab's website for about the last 11 years. I look at both open interest put-call ratios and also volume put-call ratios. Volume put-call ratios tend to be very short-term in nature. They tend to tell you what's happening like yesterday, today, and tomorrow, whereas the open interest ratios, because they're much longer-term in nature, because they gauge outstanding contracts. And I slice them down by equity versus index versus VIX, and then I look at the SPY separately and the QQQ separately. What I saw last week was the most amount of hedging and bearish sentiment that I've seen all year. And I put out a forecast of fully bearish for this week, which was the most bearish forecast I've put out all year.
Right.
So interestingly enough, people were prepared for this downturn as severe as it was on Monday, and it's really still very volatile. In general, both the institutional side, which does most of the index activity, and the retail side, they were pretty well prepared for this downturn.
All right, speaking of the VIX, let's get your volatility outlook here because we finally saw some action in the VIX, and percentage-wise, it does look a bit extreme, but when you look at it as a whole number, it's still not that elevated on a historical basis.
Not really. I mean, sometimes people look at the VIX and they compare it to its long-term average, which is around 19.25 or so, but that number is very heavily skewed to the upside by a few events like the big bear market we had in 07, 08, and also by the internet bear market from 2000 to 02. I tend to look at a different statistical calculation, which is the mode. The mode on the VIX is the most common level of the VIX. That's actually around 12.5. So when we see volatility in the 12 range, which is where it's been a good chunk of the last couple of months, that's what I call normal volatility. So even now, if it's up in 18, 19, 20 range, it is somewhat elevated. And it just simply means that there's not panic, but there's certainly a high level of anxiety and a high level of uncertainty about, well, what comes next? Well, frankly, we've got about 3 weeks before the president's imposed deadline on adding new tariffs come into play on 9/1. And I just don't think the market really knows what to make of that. Is it going to happen or is it isn't? We don't know.
And then you also have FOMC in September. So there's a lot on the horizon that would lend to more volatility or uncertainty.
Yeah, I'm not sure that the September FOMC meeting is a big level of uncertainty any more than the one we just had, because the futures markets are pricing in a 100% probability of another rate cut now already for that one. And in fact, the probabilities, I was just looking at them a few moments ago, for 3 rate cuts in September, on October 31st, and also in December is now over 60%. So the markets are telling us we need 3 more quarter-point cuts just in the remainder of this year. That's pretty remarkable.
Oh, I guess you and I, our next conversation might be around negative interest rates.
That's right.
All right, Randy, thank you so much as always for joining us.
You're very welcome.
And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.